With all the uncertainty around tariffs, inflation, and slowing global economy, market volatility is likely to stick around for the most of 2025. It's easy to feel anxious about what's next, but volatility isn't an enemy if you know how to navigate it. In this video, I will break down 6 smart investing strategies to help you stay on course, stay confident, and come out even stronger and then wealthier on the other side. Number 1, stay invested. Don't try to time the market. To successfully time the market, investors must be right twice, knowing when to get out and when to get back in again without missing the market recovery. That's extremely difficult, if not impossible, to do better than those who simply stay in the game. According to research from JP Morgan Asset Management, the market's best days often follow its worst. In fact, 7 of the 10 best days over the past 20 years occurred within just 2 weeks of the 10 worst days. If you sell during a crash, you have a much greater chance of missing the best days to follow. JP Morgan's data shows that investors who stayed fully invested from January 2005 to end of 2024 earned over 10% annualized return, turning a $10,000 investment into $72,000. But if they missed just the 10 best days, the return drops to 6%, cutting the final balance in half to $32,000. The more best days you miss, the worse the outcome. Over the past 20 years, we've experienced some of the worst market crashes in history, including the great financial crisis and a global pandemic. Yet, time and time again, the market has bounced back with benchmark indexes consistently setting new record highs. A better approach is to stay invested and use dollar cost averaging, investing small amounts consistently over a long-term horizon. Number 2, stick with the winners. Another reason many investors lose money is because they chase hype. They speculate on stocks driven only by momentum or the latest next big thing. That's not investing, that's gambling. The simplest way to succeed in investing is to bet only on the winners. In fact, investing is much easier than gambling. In gambling, winners are uncertain and based on odds. But in investing, winners cannot be more obvious. At the macro level, the winner is the US with the world's largest economy, backed by the global reserve currency, the US dollar. At the micro level, winners are the most successful and dominant companies in the world. With these companies consistently outperform their competitors, their investable securities, such as company stocks, reflect their success through continued appreciation. Lately, there's been some talk about investors losing confidence in the US as the preferred investment destination due to the tariff impact. This fear was reflected in an unusual jump in Treasury bond yields during the worst 2-day market decline since the pandemic. Normally, when stocks falls, investors adopt a flight to safety approach, buying Treasury bonds. Bonds prices go up and yields drop. But last week, the opposite happened. Investors were dumping both stocks and bonds, signaling a rising concerns of something worse than a recession, possibly a financial crisis. But not everyone agrees with this outlook. Please watch this CNBC interview with Tom Lee, one of Wall Street's most influential analysts, who shares why he thinks investors are wrong.
It doesn't need to be that people just abandon the dollar and abandon the United States to invest in. It's just on the margin, because it's a given that you cannot ignore the United States as the elephant in the room globally for all these things, for the, the currency, investments. But on the margin, it could make a big difference if there was even a slight lessening of what we were used to.
Yeah, I agree. I think that is the narrative at the moment, that U.S. exceptionalism's over and people are selling treasuries and dollars to buy other assets. But I'm not in that camp that it's sustainable, because unless weaker dollar and higher yields suddenly makes the best companies in the world outside the U.S., the best and the most important companies in the world are American companies. They've produced the best shareholder returns. And, if you look at the S&P, 40% of the returns of the S&P come from new companies every 10 years. Is there going to be suddenly the best new company coming out of Europe instead of the US because of the dollar? And I doubt it. And I think US companies are going to adapt.
Currently, there's no substitute for the US economy, which has created the most innovative and industrial leading companies on the planet. Its mature financial and legal systems, along with pro-business regulations, form the foundation that safeguards capitalism and fuels long-term growth. The sooner the global investors realize that, the sooner the money will flow back into the US. We don't need to be the smartest or most skilled person to achieve financial success. As investors, we simply need to stick with the best companies and the strongest economy in the world, the obvious winners. Number 3, don't leverage, don't short. Using leverage, borrowing money to invest is extremely risky. During crashes, margin calls force investors to sell at the worst possible time unless they can inject more capital. If stocks fall 50%, a highly leveraged portfolio can be completely wiped out. Shorting stocks or betting that a stock's price will go down is equally dangerous. While a stock's price can only fall to zero, there's no limit to how high it can rise, meaning your potential losses are unlimited. Number 4, always keep some cash ready. In a meltdown, no asset is truly safe. Stocks, bonds, crypto, and even gold can lose value. In times of uncertainty and fear, cash is king. Be prepared to buy the dip more aggressively when the fear index, the VIX, spikes above 50. Number 5, have an allocation strategy. I've discussed this in other videos. A smart allocation strategy not only protects you during downturns, but also accelerates your wealth during expansions. 2 key indicators can guide you in rotating between defense and offense: the Federal Reserve's interest rate policy and the S&P 500's forward PE ratio. When interest rates rise and the forward PE ratio soars well above the historical average, play defense by rotating your holdings from growth and technology companies to consumer staples and healthcare companies. Shift to offense when interest rates fall and valuation return to more attractive and reasonable levels. Last but not least, subscribe to this channel so you don't have to face market turmoil alone. Here I share the principles and strategies that helped me retire at the age of 50. Together, we can weather the storms. Not only can you survive the market crashes, you can come out the other side stronger and richer than before. The mission of this channel is simple: to provide you with the tools, insights, and analysis you need to achieve financial independence faster. Thanks for watching and see you in the next video.